Middle East has been thrust into a state of war with Iran, sending shockwaves through the Indian economy and financial markets. Here is a breakdown of the current situation and the ripples it is creating across various sectors. Market turbulence and the rupee slide. The domestic stock markets felt the heat immediately, with both the Sensex and Nifty plunging nearly 2% during intraday trading before making a partial recovery. The Indian rupee also faced significant pressure, breaching the 91 per dollar mark, a monthly low. While the Reserve Bank of India's RBI robust foreign exchange reserves provided some psychological comfort to investors, the broader sentiment remained jittery. Sectors feeling the heat. The surge in crude oil prices, which briefly crossed the $80 per barrel threshold, hit oil-sensitive industries the hardest. Asterisk logistics and manufacturing. Airlines, paint manufacturers, and tire companies, all heavily dependent on fuel or oil derivatives, saw their stock prices tumble. Asterisk infrastructure and exports. Major players like Larsen and Toubro L&T and certain automobile exporters faced selling pressure due to their significant business exposure in West Asia. Asterisk automotive. Maruti Suzuki, India's largest car maker, noted that while the Gulf region represents about 12.5% of its total exports, it expects limited direct fallout for now. Asterisk the safe havens. In contrast, defense stocks remained in high demand, and investors flocked to gold and silver, causing prices and related ETFs to surge. The Strait of Hormuz crisis. India's energy security is facing a critical test as movement through the Strait of Hormuz has ground to a halt. This narrow passage is the artery for roughly half of India's oil imports. Asterisk contingency plans. The Indian government is already looking at alternative routes and increasing its intake of Russian oil to plug the supply gap. Asterisk trade disruptions. Exporters are battling rising freight and insurance costs. Labor-intensive sectors like agriculture and the IT industry are also bracing for impact, with TCS already suspending travel to the region. The IPO victim, Clean Max Enviro. The geopolitical chaos claimed its first corporate casualty in the primary market. Clean Max Enviro Energy Solution became the first IPO in 4 years to list without being fully subscribed. The stock made a dismal debut, falling roughly 18% on its first day of trading. Regulatory and leadership perspectives. Asterisk SEBI stance. SEBI Chairman Tuinkana Pandey called for calm, emphasizing optimum regulation and data-driven changes to derivatives. He urged investors to ignore short-term listing pops and focus on long-term stability. Asterisk Paramo Group shared a more dispassionate view of the markets, advising leaders to look beneath the headlines for value and not be afraid to exit businesses when valuations are exceptionally high. Real estate concerns. Even the property market isn't safe. Analysts suggest that the luxury housing segment in India could see a slowdown if Gulf Basin RIs, a vital buyer demographic, decide to pull back on spending. The escalating conflict in the Middle East is creating a significant ripple effect across India's corporate and energy landscapes. Here is a deeper look into the IT sector's response and the government's urgent energy contingency plans. IT sector bracing for a spending freeze. While Indian IT firms have traditionally seen the Middle East as a high-growth frontier, the war has forced an immediate pivot from expansion to preservation. Asterisk travel halts and safety. TCS, which has over 9,000 associates in the EMEA region, and Wipro have suspended all non-essential travel to and from the region, including transit through major hubs like Dubai and Doha. NASCOM has advised member companies to activate work-from-home (WFH) protocols for staff currently stationed in the Gulf. Asterisk revenue growth at risk. Analysts warn that the industry's growth could slow to 2 to 3% for FY27, down from earlier projections of 4 to 5%. The primary fear is a double whammy. Asterisk regional delays. Direct projects within the Gulf are facing pauses as local enterprises shift focus to security and continuity. Asterisk global contraction. Rising oil prices could weaken the U.S. and European economies, causing global clients to slash discretionary IT spending, the very budgets that fuel Indian software exports. Asterisk nearshoring shifts. To maintain service levels for European clients, firms are exploring shifting more work to nearshore hubs in Egypt and South Africa, which are currently less affected by the immediate conflict. Energy security. The Hormuz contingency. With the Strait of Hormuz effectively at a standstill, India is racing to prevent a domestic fuel crisis. About 50% of India's crude, and nearly all of its LPG, cooking gas, typically pass through this choke point. Asterisk to pivot back to Russia. Interestingly, India had been reducing its intake of Russian oil down to less than 20% in early 2026, due to U.S. trade negotiations. However, officials are now preparing to ramp up Russian imports again. Russian oil is ready on the water and can be redirected quickly, providing a vital alternative to block Gulf supplies. Asterisk alternative routes and sources. Asterisk global diversification. Refiners are looking to increase procurement from the U.S., West Africa, Brazil, and Guyana. Asterisk bypassing the strait. The government is exploring using existing land-based pipelines like the Habshan-Fujairah, UAE, and the East-West Pipeline, Saudi Arabia, to move oil to ports outside the Persian Gulf, though these have limited capacity. Asterisk domestic buffers. Asterisk strategic reserves. India's Strategic Petroleum Reserves, SPR, in Mangalore, Pader, and Visakhapatnam currently hold enough oil for roughly 10 to 18 days of consumption. Asterisk export curbs. To ensure domestic supply, the government is weighing a temporary ban on the export of petrol and diesel by Indian refiners, keeping more fuel within the country. Asterisk LPG rationing. Because LPG stocks are particularly low, covering less than 2 weeks, demand management measures like rationing are being discussed as a last resort. Economic warning signs. Asterisk inflation alert. Every $10 rise in price of oil adds approximately $17 billion to India's import bill. If Brent crude remains elevated, headline inflation could breach the RBI's 6% tolerance band by summer. Asterisk fiscal strain. The current account deficit (CAD) is now at risk of widening toward 1.8% of GDP, potentially forcing the government to recalibrate its budget for the coming year. Final outlook. Asterisk the energy tightrope. With the Strait of Hormuz blocked, India's pivot toward Russian and Latin American oil is the most urgent priority. Expect the government to prioritize domestic fuel supply over exports in the coming weeks to prevent inflation from spiraling. Asterisk the defensive rotation. While consumer-facing and oil-sensitive stocks, airlines, paints, autos, are in a period of pain, the defense sector has emerged as a rare winner. Companies like HAL, BL, and PAR's Defense, which surged up to 13.5% yesterday, are seeing a massive inflow of capital as investors bet on increased regional security spending. Asterisk the currency factor. The rupee struggle at the 91 per dollar mark will likely keep the RBI active in the forex markets. Prolonged conflict could see further pressure, making imports even costlier. Asterisk investor sentiment. SEBI's call for steadiness is a reminder that while the geopolitical fog of war is thick, the Indian regulatory framework is designed to absorb these shocks. The focus remains on avoiding panic and